Welcome to Truth in Accounting's Ask the Experts webinar. Thanks to the Union League Club of Chicago for co-sponsoring today's event. Today's topic is all about our Truth in Accounting's new Financial State of the States report. We just released our 12th edition of the report on Tuesday. My name is Bill Bergman. I'm the Director of Research for Truth in Accounting. We're a nonprofit dedicated to helping citizens understand government finances with a view to promoting truthful financial reporting by government to its citizens. You can learn more about us at our website, where you can sign up also for our morning call newsletter, which compiles government financial news every day. We also offer our Day to Z website, where you can create charts and research states, cities, and the federal government on a wide range of economic, demographic, and financial information. I just made a chart there before the meeting today, comparing Illinois and North Carolina since 2009, and it wasn't a very pretty picture from Illinois' perspective anyway. We're honored today to have Mary Williams Walsh join us. Mary's a senior researcher at Blue Heron Research Partners, a firm based in New York and London that performs due diligence research for institutional investors and other clients. Before joining Blue Heron in 2021, she was a financial journalist for the New York Times, writing about insurance, the pension system, public finance, and bankruptcy, including the bankruptcy of Detroit and the Puerto Rico insolvency. So get your bankruptcy questions out there ready for Mary. Previously, she was a correspondent for the Wall Street Journal and Los Angeles Times, writing from Latin America, South Asia, Canada, and Europe. She studied accounting and finance as the Walter Bagehot Fellow at Columbia University's Graduate School of Business. Joining Mary and me today is Truth in Accounting's founder and CEO, Sheila Weinberg. Sheila is a CPA and has led Truth in Accounting's initiative since 2002. Her commentary on the federal budget and state and local government finances has appeared repeatedly in numerous publications, including the USA Today, the Washington Post, and the Wall Street Journal. For today's event, everybody's going to have a chance to ask questions via the Q&A feature at the bottom of the Zoom menu that you see in front of you, hopefully. If you look towards the bottom of your screen or hover your mouse over the bottom, you'll see a panel with Q&A. Just type your question in that box during the event, and we'll try to get to it. I'm going to turn it over now to Sheila and then to Mary for some initial comments from both of them, and then we'll get to the questions. Sheila?
Thanks, Bill. Thank you so much. And I want to start off with, why in the heck do we do the financial state of the state? It's a lot of work. Our team does a great job, and I appreciate it. But why do we do this effort? We started doing it in 2009 when we realized that the state and local governments were they weren't even required. In fact, they were required to not put their pension liability on the face of their balance sheet, and they weren't putting their retiree healthcare liabilities on their financial statements. So we're like, well, citizens and even elected officials don't really know the true financial condition of their governments. And they're making tax and spending policies based on the wrong information. And we even take it down to the role that this plays in our representative forms of government, because year after year, 49 of the 50 states have balanced budget requirements. And year after year, citizens are told, well, we're meeting our balanced budget requirements. So they might go to the voting booth going, oh, well, the governor, the legislature, my city council are living within our means, while they're going hugely in debt. And would they have voted for somebody different if they knew that they weren't living within their means, or if in order to live with their means, they had to raise taxes or cut spending? Voters just are misled about the true finances, so they cannot knowledgeably participate in their government. The findings of our report is that we found that, despite these balanced budget requirements, states have accumulated $1.5 billion of debt. I'm sorry, 1.5 trillion, those B's and T's, this is trillion. They've accumulated more than 900 billion unfunded pension debt, and more than 600 billion of retiree health care debt. We found over the 50 states, they only have 64 cents set aside for every pension benefit promise, and only 8 cents set aside for the retiree health care liabilities. We hear a lot about underfunded pension plans. Well, the retiree healthcare liabilities, they're not setting hardly any money aside for that. Most governments do it on a pay-as-you-go basis. And the problem we have with that is that future taxpayers are going to have to repay for for retirees' health care, and that taxpayer isn't receiving any government services or benefits from those taxes and from that worker. You can find your own individual state by going to data-z.org and click on your state and see how good it is or bad. We do have 11 states, so hopefully you'll go out and find what 11 states are doing well, that are ahead of the game. We have called them sunshine states, but the rest, unfortunately, are sinkhole states to some degree, with Connecticut being our worst state, moving into the worst position this year. New Jersey and then Illinois round out the bottom three. But before I go on too much with all the numbers, let me go ahead and turn it over to Mary, and I look forward to your questions.
So thank you, Sheila. I thought I would talk a little bit about how it happened that journalists don't usually get as deep into this rabbit hole as I did with public pensions. And I thought I would explain a little bit how that process happened. It was around the early 2000s that I started. It was when all the airlines were going bankrupt, basically one after the other. And in all of those cases, they had pension funds, and it was it was very sad. Everybody was afraid that they would somehow lose part of their pension. And the pilots were the most outspoken about it. And I talked a lot to the PBGC, this federal agency that insures company pensions, about what was going on. And what I learned from them was the PBGC, when a company goes into Chapter 11 bankruptcy, it does sort of like what I would call a fair value calculation of the pension obligations. It calculates the assets and it calculates the obligations. And it does so in a bankruptcy. It uses a risk-free discount rate, which is actually interesting to me and important, because they do that because they're trying to make it not just be an incentive to offer lots of pension benefits to everybody to achieve labor peace in your workplace and then just send the whole thing to the PBGC when it fails. They want to make it expensive and painful to send your pension obligations to the government and have a big outcry. And they were actually very proud of how they calculated the obligations. They had a whole method that they wanted me to know about, and they would go to court and fight for it. So then after hearing all that, somehow I had the idea to look at the public pensions a little bit. And that was really just very surprising to me, because all of these things that the PBGC was so proud of, they didn't do it at all. And they still don't do it. I mean, the accounting is better now than it was, a lot better now than it was back then. But they still don't they don't have what I would call a real balance sheet, where you can actually see, is there a mismatch here? Or how far away are the obligations from the assets? And I sort of feel like it's just sort of unfair to leave everybody in the dark about, okay, how much debt do we really have? So anyway, it was that difference between a corporate pension plan and all of the stuff. They have to jump through a lot of hoops to stay correctly in compliance. And it seems like the public ones just don't, and there doesn't seem to be a good answer for that. I'm going to stop there.
Yeah, Mary, thank you. It reminds me of, in the corporate world, they were offering these pension plans, and some of them were getting in trouble. So during the 1970s, they passed a law called ERISA, and honestly, I can't remember what that stands for, is Employee Retirement something. That set into place that, you have to better fund them. If they get anywhere below 80% funded, you have to have a plan to get that funding back up to more than 100% or more. And it caused a lot of corporations, correct me if I'm wrong, Bill and Mary, caused a lot of corporations to get out of those type of plans, because they realized we really can't afford these. We can't contribute enough money to these to make them solvent. Unfortunately, there was one line in ERISA that excluded state and local governments.
They were going to do something called PIRISA. After they were done with ERISA, they were going to create a public pension ERISA. And it just never happened. There was too much opposition. But the research was done. You can find the research, and you can find out what pensions looked like back then. And you can see, like, it just seems like this is all about not wanting to have to fund the benefits that you promise, because it's too expensive.
Yeah, and you can thank Barrett Peterson, one of our supporters, put in the chat that it's called the Employee Retirement Income Security Act. So unfortunately, we don't have a public employee retirement income security act. We talk a lot about liabilities, but we also have to think about, these employees who have been promised these benefits. They've worked for these benefits. They've earned these benefits, and they don't have a income security act. You can go on, the listeners can go on to our Data-Z website and click on we have a pension tab at the pension and OPEB tab at the top, and find out your pension plans, how much assets they have, and how underfunded or not funded they are, and how much they're contributing to those. Thank you, Barrett.
Well, we'll move to questions now. If you're finished, Mary, for any introductory remarks.
Yeah.
Good. Okay. Well, one thing I noticed in your background was interesting was you covered Berkshire Hathaway in one of your previous lives. And any perspective from Warren Buffett? We had a classic 1975 memo that he wrote about pensions. But what kind of, looking at Berkshire Hathaway's balance sheet, which is legendary for its lack of leverage and or liquidity, what lessons can we get from Warren Buffett and Berkshire Hathaway for public sector balance sheets?
He always talks about how he makes, I think it was maybe 2013, he has this annual letter and a shareholders meeting where he talks about this a lot. And I think it was about 9 years ago, he said, well, sometime in the next decade, we're going to have a lot of bad news about pensions, about public pensions. And then he talked about what it was going to be like. And we're almost to the end of his deadline. And I think things were probably going to happen in his timeframe. I actually think when the COVID thing started last year and the economy was shutting down and so many jobs disappeared right away, I thought, okay, well, this is it. It's a moment of truth for somewhere, and we just don't know which place yet. But first the Trump administration, and then after that, the Biden administration, they put out a lot of money to states and cities and gave them tools for coping with it. And so just the fact that the unemployment insurance was very much supplemented by the federal government, that's taxable income. I mean, it's like states could tax that income if they wanted to. And so you ended up with a much more benign effect on the economy than I thought at the beginning of when COVID happened. And then the Biden administration put out, $350 billion to states. And it was irrespective of whether some really did need it and others didn't need it so much.
Right.
It depended, but they all got it. And so I think that's that money flows little by little into the pension funds and is sort of tiding them along.
Yeah, and by law that's not supposed to go into the pension plans. But Bill introduced me to a word called fungible money. They might not put back those federal dollars for some. They must be able to identify federal dollars differently than tax dollars. So as long as they're not putting the federal dollars into the pension plan, they can go ahead and divert taxes into the pension plans, but not those. But it's all fungible.
Right. It's sort of like a big blur. And you have the feeling that, yes, this is what's making these pension funds that were down very low before the pandemic started. This is what's making them get through it. Okay. But it's not anything like a legitimate reform where you would try to, correct a mismatch.
Yeah, I was hoping that, when they sent money to, and I wrote a little bit about this, that when they sent money down to the states, it would have been good to have some strings attached to it, besides that, this fungible problem, they needed to start funding their pensions properly, and they, couldn't promise more benefits. The governor of Illinois, even though the city of Chicago's police and fire fund is woefully underfunded, decided to give more benefits to, it's like, in the private sector, that can't happen. When you're under, 80% funded, you can't enhance benefits. You have to increase contributions and cut benefits. But again, unfortunately, the public sector pension plans are not a part of the ERISA bill.
That's right. There was a steel company that was increasing its pensions, I think, or it had, the benefits were about to have a spike. And the PBGC took the plan over. It sort of foreclosed on the pension plan and took it away from the company. And they did that on Christmas Eve, which there was a huge outcry, but this was how, they don't want there to be just sort of taxpayer money flowing willy-nilly into pension plans that like they want to be able to control how big is the bailout going to be. That doesn't seem to be the way that we do things now.
No, and talking about bailouts, during some of these laws that were passed in relation to and money going to the states, and the federal government seemed to just open up a big hose and like we're just going to throw money everywhere. But part of a piece of that legislation, Mary, you might know which one it is that they did, in essence, bail out some of the union pension plans, like the Teamsters union pension plans. But members of Congress said, no, we're not going to do that to for public sectors unions, public sector pension plans. What do you think that they will, or are they going to just keep it to other pension plans?
It's always said that it creates sort of like a not a precedent, but it sort of like takes a step in that direction. And they first did it with the coal miners. It's a multi-employer pension plan. So just like there's lots and lots of different mining companies, but they all have one union. And so they all have one pension plan. And that plan was horribly underfunded. I mean, just you couldn't believe the condition that it was in, but it just was. And all of the coal mines were going away. They were becoming non-union. And that was the first time the federal government stepped in. I should point out with these multi-employer plans, the accounting works very much like the government pension plans. It's not ERISA. There isn't you don't have the PBGC in there in the same robust kind of role that they are with single employer pension plans. So they took over the coal miners plan, and I think that was pretty close to Christmas Eve too. And then it was quiet for a while, but then it happened again with Teamsters. They had been asking and asking and asking for years and years and years, and having, bills introduced that never passed. And then finally last December, one passed that helped the Teamsters plan. And it's kind of, I don't know what makes them decide at the last minute, okay, this is the year that we are going to bail it out. What I remember about the Teamsters bailout thing was that, in a normal situation, there would be some reforms that you would have to take to get the money. Like you'd have to say, okay, we're going to freeze the plan, or we're going to have a new type of benefit, or whatever, invest a different way maybe. And it didn't really happen. So it seems as if you could get to the end of this like federal money for that plan and then realize, oh, we have to start all over again with a new batch of federal money because the mismatch is still there.
Amidst the debates over the bailouts and the cost of the bailouts in 2008, 2009, I'm afraid that one of the underappreciated costs is the precedent, that word you use, precedent, that it's set for, and the moral hazard associated with the bailouts from 2008, 2009, for the expectation that Uncle Sam will be there for you. And in fact, people are using that argument today that, you bailed out the banks. Why can't, where's, you got to be fair. and here we are with our federal government now standing behind the system in a way that may not be healthy in the long run.
Yeah, Bill, I went to our Data Z website and looked at our pension tab and looked at Illinois' numbers, and the teachers' retirement system is only 40% funded. And my nervousness is, when the shoe hits the fan on that, you can't tell me, that they're not going to have a retired teacher who's counting on these benefits go to Washington, D.C. and testify and say, I've been promised these, I earned these, I worked and educated students for years. And, Mary and Bill, do you think that Congress will just say, oh, okay, well, Illinois poorly funded those, sorry. What do you think will happen when they don't have enough money to pay benefits?
Yeah. So I just want to step back 1 second and say that when if it was 40% funded, I think it was maybe 36 or something. But anyway, when the U.S. Airways was going bankrupt way back almost 20 years ago, that was another one where it was running with the actuarial liability measure running along. And then the PBGC came in and marked it to market basically and measured the liabilities the way it would, as it's a backstop for this plan. And all of a sudden it fell from something like 70% funded to 40% funded or something like that. And it was like a huge, huge uproar. The pilots were the ones that were going to, They were afraid they were going to lose their pensions because of this, and they didn't know who to believe. Do I believe the numbers before we declared bankruptcy when it was our company that was saying it was 70% funded? Or do we believe the PBGC? And I actually feel sort of like ordinary workers in their workplaces, whoever they are, that shouldn't be their burden to have to figure out something like that. Like there should be some credible explanation to them for why what's going on is going on. And it shouldn't be able to change like that overnight and all of a sudden leave everybody in the lurch, which, I mean, it's such a shock to people. I was paid all those years to do, figure out what's going on with these different pension plans. But for the rest of, the people who participate, it's not really fair for them to have that responsibility. They should get good numbers.
Well, this opens the door to another question that we prepared earlier. If we could, for our audience, could we talk a little bit about what are discount rates in pension land, very simply, and why do they matter? And what discount rate are they using compared to what they should use, Mary?
So a discount rate is a very hard thing to explain to people who have never had to understand it before for any reason. And it seems like the comparisons that I know are with things that don't even really exist anymore. Like I can remember a time when you always bought a savings bond at a discount and that was just known. And that meant, it's going to get 4% annual interest. And by the time it matures, it will be 100%. So, but nobody thinks about things that way really anymore. But it is that rate. It's the rate between like what it's going to be worth in the future and what it's worth now. And there's all sorts of controversies all over the place about what that rate should be. These public pension funds are supposed to be absolutely risk-free. Like you're not supposed to get to the point like the pilots did at US Airways, where all of a sudden you get a new calculation and you find out it's only 40% funded. It's supposed to be like all the time you can sleep at night and know that you're going to wake up and your pension is still going to be there. And so because if it's a risk-free pension, then you should be using the theoretical argument is, and what an economist would tell you is, if it's a risk-free pension, you should be measuring it using a risk-free discount rate. And unfortunately, right now, the average discount rate for these public plans, I think, is about 7.5. And if you have, treasuries are supposedly risk-free, and they're down around 1% or something.
Supposedly, interesting. I'm sorry. I'm sorry. Go ahead.
No, I don't mean to go on and on, but anyway, you can't it just causes a real problem, because if you did use a risk-free discount rate, and as many economists say these public plans really should, everybody looks bankrupt. They really do. Everybody, it will go from like whatever the funding. Okay, Illinois teachers, if it's 40% funded using whatever rate,
7%.
You can't bring it back from that point. You can't dig yourself out of a hole that deep, I think.
Yeah, and again, the discount rate doesn't just affect, in the future we're not going to be able to pay the benefits because we, haven't used the proper discount rate. It affects how much the governments currently contribute. So if they have a higher discount rate, then they're not contributing enough to properly fund these plans in the future. But the Government Accounting Standards Board lets these governments use this, what they call historical rate. And honestly, if these pension plans can earn 7%, then I'm going to give my money to them so they can earn 7% for me. And the other thing we were talking about,
or have the federal government step in if they don't.
Yeah, and the other thing we were talking about before in our pre-webinar conversation was that these governments are using this 7%, saying we're going to earn 7% every single year. Some years they earn maybe 10%, but some years they earn 3%. Well, my argument would be when the market is high, these pension plans should actually be overfunded. So they can take the hit when they go down low. But we're looking at all the, we have the fun at Truth and Accounting of reading a lot of these pension plans reports. And, during the good years, almost in headlines, it's like, hey, the plan earns 12% this year. And in the bad years, when they either only earn 1 or 2 or 3% or lose money, there's very little mention of that. But again, they should have, but correct me if I'm wrong, Bill or Mary, I think that, these plans should be overfunded during the good times And would the governments let them overfund them? Would they let them have this extra money in it, or would they do other things to not have them have this extra money?
Bill, do you?
One reaction I have is a lesson from banking regulation and banking history. Following the 1991 FDICIA legislation, we had a new concept introduced in banking resolution and resolving failing banks, a concept called prompt corrective action, or PCA. When you're faced with an insolvency situation, the regulators, in theory, should get it resolved as soon as possible. Otherwise, the bankrupt entity has incentives to gamble to get out from behind the problem. And to what extent are we facing that issue today in many pension plans, I'm afraid? And we have a lot to learn from banking history that we don't learn, and that's one of them, I'm afraid.
Well, my thought is that the elected officials, and I've seen it, we saw it in Idaho just this year. In Idaho, their plan was getting to be 98% funded during those last 3 years before the current crisis. So they went and I think they were $2 billion. I can't remember the numbers exactly, but they were $2 billion over. They only had $1 billion of debt. They went ahead, and because it was so, quote, highly funded, but keep in mind it's good times, so it should be highly funded, they went ahead and adjusted their COLA, which caused the plan's unfunded liability to increase because they're going to have to pay more benefits. And then when the crisis hit, they lost $500 million. So now their plan is $2 billion underfunded when it was only $1 billion underfunded the year before.
Well, in thinking about resolving failed institutions in general, Mary, you've got experience in the bankruptcy area. So our next question is bankruptcy something that local governments should avoid at all costs, or is that, possibly one route to take in resolving the problems that Illinois and others are facing?
Yeah, so states, there isn't a bankruptcy chapter for states, first of all. There is for cities and counties and other subdivisions like that. And so, and Puerto Rico, it basically has a bankrupt government, but there wasn't a chapter for territories. And so Congress created one, but they called it PROMESA. So it's like a bankruptcy thing, but for territories. So anyway, there's some that just can't. I looked pretty carefully at Detroit when it was bankrupt, and what you could see was that there were years and years and years when everything was just getting worse and worse and worse, and people were moving away. That was a big problem. Their tax base just sort of dwindled away. And if they had declared bankruptcy earlier than that, the way it turned out, like the people who didn't have the wherewithal to leave Detroit when it was in its decline, they were the ones kind of stuck going through the bankruptcy and being told, you're the taxpayers who are going to have to pay for all of this stuff. I mean, they just couldn't. It was totally unfair and unreasonable. And it really seems like there were a lot of bad things going on that contributed to Detroit's problems. But one of the things that I could see was if they had declared bankruptcy even 10 years earlier, people wouldn't have been hurt as badly.
Yeah.
But
unfortunately, I think the governments have a tendency to operate by crisis. They don't do anything until until absolute bad crisis happens, instead of planning in the future. And I've started to wonder, and one of our guests, mentioned that, back to this overfunding idea, that if the plans did get overfunded, then the local boards would say, well, we can reduce taxes because, we have too much money into the plans. So there's all these, one, I get nervous because the legislators and the people who are the upper management of these plans, the top management, you can't tell me, Mary, that they understand discount rate and all these issues. And then, even if they did, the politics get involved. So the question I have is, do we not have hard evidence that the political system cannot manage these defined benefit plans properly?
I have to refer to the mayor of Detroit right before the bankruptcy was David Bing, and he was a very decent fellow. And I went to one of his presentations before the bankruptcy, and he put this little picture of a yin and yang symbol, the little black and white circle, on his projector and said that he was comparing the pension issue of Detroit to that. And he was saying, on the one side, we know what the thing is that we have to do to get things right again. And on the other side of it was that thing that we figured out is the thing that we cannot do. And he saw this as all sort of interwoven, that by the time you were in the middle of it and you'd understood it well enough to see this is real and it's bad and we have to do something, we can't do anything anymore.
Interesting.
I also remembered that because he seemed so level-headed about the whole thing and had sort of like a Zen attitude almost.
Interesting. Well, we're getting our questions are coming in. Please, everybody, go ahead and ask questions. But here's one of them, actually not quite a question, but a statement, followed by a here by Mary Pat Campbell. She liked this statement. The statement, Mary, is one of Mary's most important accomplishments for us was exposing questionable actuarial practices in Illinois municipal pension plans. Does that ring a bell? Do you have a recollection of the actuarial assumptions that were? There's
more than one thing, but what I think was there are some actuarial techniques that it's called the ultimate something actuarial liability method or something. The word ultimate is in there. And it doesn't mean it's like a super duper powerful thing. It means we're going to use the ultimate workers that are going to be hired in the future, like the last ones hired in this group. Their characteristics are going to be used to calculate the obligations to this whole group, which isn't valid because those people are going to have, if they're in a smaller tier, their pay will be less. And so their pensions will be earning less. And they were sort of funding to these future ultimate people who are going to have early, smaller pensions. And it was a way of sort of defunding the pensions of the current workers. You couldn't see it. If Mary Pat can probably explain it better than I can, but it was that. It was like sort of taking something that we know we're going to have to do in the future, but it's cheaper than what we have to do now. And we're going to pretend that we're doing that now. Not good.
Yeah, I know. I think it's in Indiana. They actually, and I think other governments have done it. They've gone ahead and said, oh, okay, well, there's this bad system that's horribly underfunded, and we're going to make that a separate pension plan, and we'll continue to do, bad calculations and bad contributions, but we have this new pension plan, and that will do better over here. And then they seem to highlight that, oh, well, we're doing good. Look at over here, we're doing great, and just kind of try to ignore this bad one. And they're just like, well, it's a legacy cost. And, we really didn't we didn't create it. So we really don't have to solve it. And they just leave it over there, hoping that, eventually it'll go away, but it won't.
There was something about the Detroit bankruptcy. It was the first municipal bankruptcy that I looked at that it was as big as it was. And I looked at it as carefully as I did. And I expected that Detroit, at some point in the bankruptcy, they would do what the PBGC did for company pensions and market the obligations so that, in the bankruptcy, like you're not, like the future has kind of stopped for the time being. You're not going to be getting, like, it's just kind of frozen. And at that point, you should use a risk-free rate and calculate, like, what do we actually owe, not counting anything that's going to happen in the future. And that never happened. So you never really, with the Detroit City pension plan, you never found out, well, what is the real mismatch and what is really the obligation that the taxpayers here owe. And if you can't calculate that, then you don't really know how to restructure it, do you? Like you don't, well, how much do we cut to make sure this is a viable pension plan going forward? I hate to say it this way too, because I feel as if I sound like I want to cut everybody's benefits, and I don't. It's that once things get that bad, there's not going to be a good outcome. I mean, and sort of masking how bad it is just makes it easy to, not easy, it's hard to restructure it, but you can still make it look like it's going to work when it might not.
Yeah, and at Truth in Accounting, especially doing some of my speeches, people, well, you guys are trying to cut pensions. And I'm like, no, we're not trying to cut pensions. We're letting you know how much debt it is. And I actually think it's almost immoral for these governments to go ahead and elected officials to promise these employees these benefits. They earn them. They're part of their compensation package. Some people would argue that, the employees, if you include those the retirement benefits are actually making more, but that, but again, the employees have been promised them, they've earned them. I think it should be, they should go ahead, the elected officials should go ahead and and fund them properly so people, benefits that they're counting on are not jeopardized.
When you said it's almost immoral, it reminded me of the term that economists use, moral hazard. Now, I don't know where that term comes from, but this seems to be a very good example of one, because the people who are going to be on the hook for it, like local property taxpayers, if it's a city pension fund, they have no idea why would they? You have to actually spend a lot of time sort of digging in and figuring out what the funding level really should be, rather than, there still isn't a balance sheet the way for a company there is. And if there were, you'd be able to see it right away.
Well, also, these plans, one of the reasons I think these plans have gotten a little out of control is because they aren't calculating them properly. And then on top of that, another tier on top of that is, going back to the balanced budget requirement. So if they calculated them properly, then they would have to fund them properly, and then they might have to raise taxes. Well, then people would be going, well, how come we're paying so much in taxes? And it's like, well, because these benefits have been promised, and people might have earlier, the taxpayers might have said, hold it, stop, and paid attention to this. But because they don't calculate them properly, and even if they do, and then they don't fund them properly, and then they say their budget's balanced, again, everybody thinks everything is fine. And why are organizations like Truth in Accounting bugging us with this debt? And even the governor here in Illinois, just says that we don't know what we're talking about. It's like,
yeah, it's for journalists, it's like that too. I was always trying to sort of figure out what the middle ground was and not take sides like, yes, the pension is valid and it should be fixed and no one should ever have to lose their pension. And then the other side is all of this stuff is, they just promised way more than they can deliver and we need to do something. Trying to find the middle ground just got impossible. Over time, it just seemed, especially in the last 5 years or so, it just like you couldn't, it seemed like there was no place where everybody agreed.
Well, it's an impossible situation, so I think it's impossible for everybody to agree on things, because it's just in some of these plans there's just no good answer.
Right, it has gotten to that place where it's so bad you're going to have to do something else that's bad to fix it.
The insurance world has long made a distinction between, you'd mentioned moral hazard and morale hazard, where morale hazard is once you have insurance, you take more risk. It's a natural thing. It's not evil. But in insurance, what happens if the incentives are to actually cause the loss that you bought insurance for, which is when you move into the quote moral hazard category. And I'm afraid drawing that line here, especially in light of effectively the insurance that the federal government is provided for our financial system and to these pension plans, where do you draw the line on from going from morale hazard to moral hazard? I'm afraid our representatives need to take responsibility for the situation that they've erected. We stabilize things in the short run with long run destabilizing consequences, I'm afraid.
Yeah, and our founding chairman, Roger Nelson, always talked about that the federal government has actually become a huge insurance company. And, whatever happens, they provide, there's a flood, they provide money for that. There's financial instability, they provide money for that. But again, Mary pointed out the insurance companies, they have to be fully funded in order to, provide the
exist.
Go ahead.
Just to exist, basically, to stay in business.
Just to exist, they have to have all these reserves set aside. Well, if you just look at Social Security and Medicare, the federal government, we have on our quote debt clock, is more than 130 trillion, going back to the T's again, underfunded. And if this concept of, well, if you're an insurance company and you should have enough money for all your exposures, then they shouldn't be $130 trillion in the hole. They should have $130 trillion set aside so that these benefits, and then they should even have more because of the floods and the financial crisis. And instead, we borrow that money instead of having it set aside when we need it.
Or print it down the road. we have a few questions we'd like to get to. One of them was a follow-up question on the Illinois actuarial assumptions and Mary's contributions. A more specific follow-up question from Mitchell Serrata asked Mary, can you talk a little bit about those mortality tables and or one of the, okay, good, that rung a bell.
When something's wrong, it sometimes is more than one thing, and you have to sort of tease them apart. There was that ultimate actuarial thing, but also there were some wrong mortality tables being used. I think it was mostly with police pension plans in Illinois, which are separate from other types of pension plans and locally funded. And you could see that the mortality table that they were using, I think, was from a population group that was born in something like 1910. It was a very, very old group with higher mortality than we would have today. And if you are assuming there's going to be high mortality, then you don't need to fund it as much, because you don't need as much money because people won't live as long and they won't receive as much total payments. So, and it was, and everybody was happy with that, because this is where I start thinking about moral hazard. The people, it wasn't just the policemen who were happy with that. It was the local, towns that it meant they didn't have to fund as much. And when people started saying, wait a minute, this mortality table, I think it was even the Society of Actuaries started a project that they were going to implement a more modern mortality table, or force people to make more current assumptions. And the towns didn't want to do that either, because it's like what you were saying before, Bill, it means they're going to have to get the money from somewhere, and their taxpayers aren't going to like that, because that's where it's probably going to come from.
Yeah, once that I spoke in Elgin around that time and heard of other, suburbs of in Illinois, those local governments who were using. In fact, I think the actuary was kicked out of the actuarial society. And again, though, these governments were contributing, way too little. And then once they adjusted and got the actuarial and mortality schedule in there, their liability just massively increased. And again, they're just sort of like, well, nobody took responsibility. It was like, well, the actuaries changed the numbers and now we owe a lot. Instead of, it's like, well, you should have been funding more in the past. And I think there was one suburb I went and spoke to where their contributions just went up by tenfold. Because they use more realistic actuarial assumptions.
People get really upset about that. I mean, it comes up your property taxes probably. Those are all local plans. Yeah, it's with this, and then the ultimate thing I was talking about, which everywhere doesn't use, but it was sometimes used in a few places, and then just a too high discount rate. All of those things come together, and what you can see is there's the only person who's interested would be in to correct all that and give truthful numbers are just the people who live there. And they don't seem to be represented in this at all. They're not organized like a union would be. They're not elected. They're just sort of trying to live through this. And they're the ones who would really benefit from having more accurate numbers. The local officials, I guess they think they wouldn't benefit, because then they'd have to raise taxes and everybody would be unhappy. And they would say, what, why did you tell us it was 80% funded when it's only 40% funded?
Well, we have a question related to a topic we were talking about earlier. It's more of a statement than a question, but it's an interesting observation from Don Nemerov. Don has written, FASB issued statement number 87, Employers Accounting for Pensions, in December 1985. Setting standards of financial accounting and reporting for employers who offer pension benefits to their employees. This changed everything in non-public pensions, requiring a book cost for pension liabilities. GASB never crossed this bridge for some reason. And then he says, can guess. So I guess the question is, can you guess? Well, why didn't?
I think GASB was formed because of this. I think that there used to be just one accounting board for both governments and companies. And it was over this pension controversy. Like the governmental accounting people, they just didn't want to accept that. And accounting standards have to be accepted, right? We're the generally accepted accounting. They wouldn't accept it. And so they said, okay, for various reasons, we don't think we should have to use the corporate accounting. We're not corporations. And it's true, they're not. They don't have shareholders. And lots of stuff doesn't happen in governments the way it does in companies. But then they did their own pension accounting standard. it was actually very controversial, even though they didn't do it the FASB way. It was a softer, but there was one member back then of the GASB who they published their accounting standards in little paperback books at that time. I don't know if they still do, but he put a dissenting opinion, just as if he were a Supreme Court justice, into their book. And it was really interesting to read that years later, because you found out, wow, I mean, this was really red hot, even way back then in the 1990s. And he felt that it wasn't a good enough standard and there were going to be all kinds of problems, but he was outvoted. So he got to write down his point of view. And to me, it seemed like when you read it years later, he was right. But I mean, it has to be accepted. And I think the other ones knew that if they did it the way he wanted, governments wouldn't accept it.
Yeah, and one thing that they did that in the 90s, and they have updated, in the 2000s, they went ahead and updated that. So they got a little bit better. But when they first did the standard, the way that standard was written, when Detroit went bankrupt, the crazy way that standard was having them do the accounting, instead of showing their hundreds of millions of dollars of unfunded pension liability on their balance sheet, they actually showed a net pension asset. And then GASB, I think GASB kind of sat back and said, "Oh, well, that doesn't look good." They realized that other governments, are going to struggle in the future, and are people going to point the finger to GASB? And then I think the SEC had a little bit of whispering of like, this isn't quite kosher, guys. So they improved it a little, but they did not, improve. They improved the discount rate a little bit, where they say, well, you can use that historical discount rate until you run out of, until you anticipate you're going to run out of assets. But then once you run out of assets, you're going to have to use the market rate, because we're going to assume that you're going to have to borrow the money to contribute. So the rates, some rates are going down a little bit. And I think it would be, we haven't had the resources to do it, but it would be a good project to go ahead and point out to people, because the governments are now calculating when these plans are going to run out of assets. And it would be good for people to know that, hey, they don't have enough money, and they don't have, I think the thing that with the unfunded liability is they really don't have a plan to fund these. It's just there. They're just there.
They want to grow their way out of it. With
those dissenting opinions are worth reading sometimes, Mary, and including more recently, we've had, there's a new project at GASB for the quote financial reporting model improvements project. And we got to recommend at least one dissenting opinion by Michael Granoff, Granof, a very cogent argument against what they're proposing. Another person that's worth reading, the comment letter from Martin Ives, former GASB member, is a wonderful dissection of these proposals from GASB that are out there right now. Sheila was just talking about something that was a product of a question from from the audience member, Barrett Peterson. Can we please talk about the GASB requirement for this quote blended discount rate if the plan is expected to run out of assets? What is this blended discount rate stuff?
So it's sort of what Sheila was talking about a minute ago. You are required now to do a calculation, and you're required to do it right. You say what assumptions you used, and then find out what, if things are going in a certain way, then how many years would it be before you run out of money? And if you find out that you're going to run out of money in a certain number of years, then you use, suppose it was going to be you have a 30-year expectation for your plan, and you're going to run out of money after 20 years. You would use, for the first 20 years of discounting, you can use your return on asset assumption because you have assets. And then after that, when you don't have money for the next 10 years, you use your borrowing rate, and then you sort of blend them by blending the 20-year number with the 10-year number. I don't think I explained that very well, but maybe you see what I mean. It's that blending. It still isn't the risk-free rate that some actuaries were calling for at the time. And it's sort of like one of these compromises where everybody's unhappy. It's hard to understand. There's also a way you can opt out of it. If you can make a certification that you believe you're going to get all the contributions you demand of your employers, you don't have to use the blended rate. You can use your return on asset assumption anyway. And if you look around, you can find some states that it seems like they could opt out of that. And so that's why there was one, I can't remember if it was Missouri. I'm sorry to not be able to remember it, but there was one, maybe it was Kentucky. They got caught by that. They couldn't make a certification that they were going to get all their pension contributions. And so they had to use the blended rate, and immediately their liabilities popped. And they were upset about that. Like they got caught and a lot of other states didn't get caught. And you could sort of see their point because it wasn't comparable in, do you see what I mean? It's like some were using the blended rate the way they were supposed to, but others made a certification that entitled them to opt out of it. And I don't know, it's a lot more complicated than it was before.
We ran into that. I think there was California's teachers plan. They calculated how much unfunded liability would be using the new standard, and they were going to have to use the blended rate. So they went ahead and said, okay, well, we're going to fund it better in the future. So it seems like they can, and I think, I know that I think Hawaii did that with their, and Alaska did that with their retiree healthcare benefits. They were like, well, even though we really never funded this well in the past, we have a law right now that says in the future, we promise we will go ahead and fund it. They put a little bit money aside, and it'll be very interesting for Hawaii because with their retiree healthcare, they did use the higher, even though they have, I think they have very minimal assets in the plan. They were able to use his quote historical rate, even though they haven't had a historical rate because they haven't had any assets. But anyway, that's another matter. And they switched to the rate. But then during this crisis, the governor went ahead and said, well, we're not gonna make the contributions that we just promised we were gonna make, so we could use the higher rate. And it'll be very interesting to see what what the actuaries or the accountants do with that. Are they going to make them go back to the lower rate? Or are they going to go, well, that was just a bump in the road, and they'll be able to continue to use the higher rate?
That's a good point. And if you're trying to issue debt, when you say something like that, to me, that's a problem too, because when you're issuing, if you're going to issue bonds, if you're going to borrow, you have to make announcements to the public markets that are accurate. And so if you're saying, oh, we're going to contribute, except we're not going to contribute, you say that later, there's a very big contradiction there, and it should matter.
Well, that relates to another question from audience member Mary Pat Campbell. Mary raises the question, the SEC the SEC dinged both Illinois and New Jersey for some of their statements, RE pension valuations and state general obligation bond offerings. Can we talk about this SEC developments and or the use of the word fraud? Does that matter?
I can remember what the SEC did with New Jersey pretty clearly. It wasn't just that it was using the wrong discount rate. It wasn't just like something that you could sort of throw up your hands and say, well, our actuary told us that would work, so we did it. There was actually something going on where they had created this special reserve account, and I think it was for the teachers. This reserve account was supposed to have money in it that was going to fund a benefit increase. And there wasn't any reserve, and there wasn't money. It was sort of just this thing written down that it was the difference between the actuarial value of something and the market value of something, which is just like the difference between two numbers. It doesn't have anything to do with real dollars. And that is such a imaginative and creative and well thought out way of making it look like you have the money when you don't. Do you see what I mean? Like it's inventive. And that was why the SEC, I think, got interested in the fraud implications of this, because it wasn't just sort of potentially an innocent mistake that you wouldn't know the consequences of. It was like creating a reserve that didn't exist, putting it in your books. And then, and the SEC also, like, they don't have any authority to say pensions have to be funded. That's not what they're there for. But they do have the authority to say, if you're going to borrow, you have to tell the markets, like, what are they competing with for their bond payments in the future? So that was why they could say that that was a fraud, because New Jersey did that for a few years, and the thing with the fake reserve, and it was borrowing from the bond markets.
Yeah, and I'm intimately familiar, unfortunately, with the Illinois situation, where in Illinois' bond offerings, they were saying that they were going to they had a funding plan to fund the plan 90% over 50 years. And the SEC officials looked at that plan, calculated that, and said, and what they did is they did a ramp. They said, well, when I'm in office, I don't want to contribute a lot because I'd have to raise taxes or cut other spending. So I'll go ahead, and they ramped it up. And a former SEC official called that ramp up a balloon payment on steroids. They figured out that when you ramped it up, there was no way you're going to have enough tax revenue to pay those ramps. So you really weren't going to fund that. So they made them take out of their bond offerings. They charged them, and the outcome was that out of their bond offerings, they had to take out that comment. And if you do look at their bond offerings, it does say that the plans are not funding them properly using this payment scheme. But interesting enough and frustratingly, Governor Pritzker, when he came out with the balanced budget, said that our pensions are fully funded. But they're fully funded using this scheme that the SEC, in essence, said was a fraudulent schedule. But he's fully funding that scheme. And I've been doing research in relation to the anti-fraud provisions. And there is a memorandum, I don't know if you've seen it, Mary, a bulletin from the legal staff of the SEC talking about municipal anti-fraud. And they go beyond that. Illinois shouldn't have just had to fix those statements in the bond offerings, that any elected official or any statement that the government makes is part of the anti-fraud provision. And I'm just dumbfounded on why they wrote that bulletin, and then if they wrote that bulletin, why they're not taking action in relation to that bulletin.
I think that they're defining in Illinois, I think they're defining fully funded as we're making the whole actuarial payment that we're scheduled to make. It doesn't mean you have enough money to pay everything that you owe over time. It just means we made our contribution this year.
I'll interrupt. They're fully funding what the legislature said they should fund, not what's an actuarially determined contribution amount.
And even the actuarial determined contribution amount, I think, would probably be too small because of this discounting issue that is it's the thing that everybody gets the most upset about.
Oh, we got one more time for one more question. I'm gonna ask another question that's not a question from Don Nemerov, and just to get your reaction. I expect that somehow Fed funds for COVID recovery will somehow end up in the Illinois pensions. His statement is interesting in light of the fact that the American Rescue Plan theoretically forbid the use of that money for pensions. What is Don asking here? What issue is he bringing up?
That money is fungible. That it's funny. The states are also independent from the federal government. They're sovereign co-equals, and so you really have to have something terrible going on for the SEC or any federal entity to tell them they should be doing something a different way. So I think that this money being fungible permits this to happen. And then something awful would have to happen before there would be like the federal government saying, no, don't do that, because the states are independent. They're not under federal regulation for this. So that's what I think.
Bill, and also that money was not supposed to theoretically be paid to, for unfunded, unpassed bills. But just coincidentally, the Illinois comptroller has a website that has the unpaid bills. And before going into the crisis and before getting this federal money, they were at $5 billion. And then just coincidentally, after getting Fed money, they went down to $3 billion. Just saying.
You're not supposed to use the federal money to give tax reductions either, to give tax holidays. My city where I live, before this money came along, they had scheduled a tax reduction and everybody was so happy. And then the federal money came and it was announced that you weren't supposed to use it for that. But they're not changing that. It's too popular.
Interesting. Well, we got to wrap it up. It's 12:30 Central Time anyway. And just a quick, wonderful thank you for Mary for joining us today. We got a lot of respect for your work and your history, Mary, in this area, and we really appreciate your participation. Thank you, everybody, for joining us. And
Thank
we'll
you.
See you again someday.
Thank you. Bye.
Bye-bye.